Let's bring in Cullen Roche, CIO at Disciplined Funds, continue the conversation. So, Cullen, it seems like to some degree the Fed chair is trying to have his cake and eat it too. Usually that kind of, and we use that phrase when things are going to go wrong, but so far, has it gone wrong for him?
No, that's actually one of the most shocking things about the rate hike cycle so far is that it actually looks like they've got sort of a soft landing on their hands here. And, I'm starting to get a little more worried about, are they on the verge of actually scoring a touchdown, the touchdown that nobody thought they could actually score? And are they closer and closer to the verge of fumbling the ball inside the red zone here? So, the interesting thing, I sent you guys a chart of where Fed policy is these days. The interesting thing about what's going on right now is that it feels like they've been raising rates for a really long time. But the reality is that Fed policy only started to actually get legitimately tight in probably about Q1 of this year. So when you look at the overall rate hike cycle here, the Fed has probably only been tight for about 6 months. And so it's interesting. I think 2024 is going to be the year where we sort of definitively find out, did they achieve a soft landing, or are they going to be forced into more of a rate cut cycle because of something that looks more like a hard landing?
That's where it gets pretty fun indeed. So how do we, let's set the terms now. So if they have to do a full reversal and start cutting, then that wasn't a soft landing probably, right?
Yeah.
So we measure it by what? They can hold the rate for like 6 months, a year?
My view would be that, are they able to, is a soft landing is a scenario where they actually put the plane down on their own volition. So do they bring rates back down? They want to be at like 2 to 3%. I think that's where mortgage market can find kind of an equilibrium, and the broader bond market and credit markets can find kind of a natural equilibrium in there. And so I think they want to get back down to that 2 to 3% level. But the question is, are they going to bring rates down on their own volition, or do they get forced to bring rates down because of something outside of their control? And I think that any scenario where they're forced to cut, especially in sort of an emergency scenario, I think they made a policy error. That means they probably raised rates too far, too fast, and then they were forced to backpedal a little bit. So we'll see. Are they able to lower rates on their own volition or not? I would say that's the definition of whether they achieve a soft landing.
Okay. So far, then we have to say they're doing a pretty darn good job with all the data coming in as much as it is. The rest of the world, they've already fumbled, and the team has scored on the other end of the field, basically. China shooting itself in the foot. Euro area basically has to stop fighting inflation for the moment because it's wrecked their economy doing so. It's looking like we are far out and alone here. So then why the concern? How do we sort of assign a probability then of a sudden misstep? We kind of went through it with the regional bank thing, and people pointed that as like, all right, this could be the big credit event. Can we now kind of sleep easy thinking that something like that is not around the corner?
No one ever knows. I mean, that's always the thing. These sort of seismic events that cause recessions, or especially credit events, they're always things that people actually don't foresee. So like, it would be shocking to me if this came out of like the commercial real estate market or something, or like the residential real estate market. To me, it would be something that's more sort of unknown, a name that we aren't really keeping our eyes on, that all of a sudden kind of pops up, and then people start talking about this thing that is causing a big problem. And so, it's going to be whatever it would be that would cause a hiccup, I think would be unforeseen. But I think the right way to think about this stuff is that what's tricky with credit policy, and especially, the way that monetary policy impacts credit markets, is that the longer and longer they stay tight, the more and more that screw kind of grinds on credit markets, because that means more and more contracts are sequentially updating at this new adjusted rate over time. And whether that's, credit card loans or commercial real estate or whatever it ends up being, it could be something foreign in the, the euro dollar market or something like that, where a foreign country's having trouble updating their overnight loans or whatever. That's the thing that gets troublesome. The longer and longer the Fed stays higher for longer in an environment like this, where the U.S. economy is not structured to have permanent 5, 6, 7% rates. The mortgage market for sure is totally broken with an 8% mortgage rate. So, the longer they stay like this, the higher the probability of some sort of unforeseen event forcing them to reduce rates is. And so we'll see. Are they able? To me, it looks like inflation is coming down. It's not coming down as fast as they want, but it's coming down. Goldman expects, core PCE to be at 2.5 by the end of next year. That would be a huge success for the Fed if they're able to bring core PCE down to 2.5 and keep the unemployment rate from exploding.
Yeah, okay. Now, right now, there's also a lot of talk about the bond market doing their work for them. And I want to get your take on that as well, because I heard him talk about that again today. I hear a lot of that discussion. But I have a little bit of an issue kind of wrapping my head around it, because they've been on the pause and the patient program. So we've seen that curve steepening, which generally is a good thing. And all the economic data has been beating expectations. I mean, if they're looking at this yield move higher as doing their job for them, but the yield move higher is now reflecting a stronger than expected economy, does that not set them up to potentially make a mistake here by being too passive? If they're like waiting for the 10-year to do their job for them, but the 10-year is going up because we're doing 300,000 NFP prints, I mean, that kind of seems like a recipe to let inflation start to, simmer, if not maybe grow again.
Yeah, I actually think that we're getting closer and closer to a point here where the more the long end moves, the higher the odds are that the Fed is going to have to come out and start communicating it lower, because the long end is essentially pricing in, it's essentially doing a couple of rate hikes here in the last couple of months on behalf of the Fed without them having to even do anything. And so, that causes all sorts of problems in the longer end of the credit markets and credit cycle. And so I think that there's a chance here if the so-called bond vigilantes and the longer end of the yield curve starts to, accelerate higher, there's a real chance the Fed's going to have to come out and do something unusual, like back off of some of their quantitative tightening and things like that. So we're not quite there yet. And the Fed certainly isn't at a point, I don't think, where they want to start communicating anything remotely close to easing. But if the long end keeps moving the way it is, I think that's tightening this screw in a way that I think the Fed actually doesn't want it to be tightening.
Boy.
And I think they'd have to send a signal potentially, if this trend continues into Q1, Q2 of next year, and if you see 30-year rates at like 5.5%, 6%, I think the Fed might have to come out and start backpedaling on some of this stuff and
that's
saying,
what worries.
Whoa, you bond traders out there who are selling this thing, remember who the big guy in the room is, because we can smash you whenever we want. And when we do, we can send rates wherever we want.
But can't they only smash by getting even more aggressive? It seems like the only thing that would put a bid into the long bond is if people think they're going to break the economy. If Powell comes out and goes, yields are going up too fast, boy, we need to cool off, I would think yields would blow out even faster, because then all of a sudden we're going to be cutting rates when we're doing GDP at 4%. Like, that's kind of where I worry about the interpretation of it.
I love this environment because there's a narrative for everybody, so GDP now comes out this morning and it got reduced to 1.2%. So you've got, Q3 GDP at 4.9, you've got Q4 expected GDP now at 1.2. I mean, if you're a permabull or a permabear in this environment, you're just loving it because you can make up whatever story you want. And so, I don't even know which one to believe now. Is the economy at 1.2 or is the economy at 4.9? I mean, I've kind of been saying all year that we're in this sort of muddle through. It's probably something closer to the middle there. But yeah, it's like a, make up your own narrative sort of game at this point. But I think the truth is probably closer to that 1.2% number.
Okay.
And I think the rubber's going to start to meet the road here with rate cuts, or with the rate hikes as we enter into 2024. We're going to start to see what the real state of the economy is here. And, I'm not like super bearish or anything, but I think that 4.9% figure, for instance, and a lot of the non-farm payroll prints that we've been seeing recently, I think they're overstating the strength of this economy, and that we're still very much in the digestion process from the COVID boom.
Sure.
And we're not necessarily at a bust point, but a lot of this mean reversion still has to happen, and it's taking a lot of time for that to happen.
All right, good to catch up, Cullen. Thanks a lot for the thoughts.
Thank you, Oliver. It's great talking to you.
Likewise, always fun walking through the logic. Cullen Roche, Disciplined Funds.